Well, I'm now joined by my guest to really explore the earnings season so far and what it really tells us about the state of the banking industry, of course, at this point in time. Just this week, we've had Barclays, Lloyds and RBS all posting profit that beat analyst estimates as bad loans decline. We're here to discuss those results and indeed some of the bigger earnings of the past week is James Ferguson, Head of Strategy at Arbuthnot Securities. Good to see you. Thanks very much for coming in. So one trend that has emerged in the second quarter, and we keep talking about it, and it's really right across the board for every bank, is a fall in bad loans. Is this trend likely to continue?
I think it is actually likely to continue. The real thing about it is, what is it telling us? People look at the fall in bad loans and they think that banks are provisioning less. That must mean that they've probably got less hidden losses still tucked away in the back cupboard, as it were. But that doesn't necessarily mean that at all. What banks do, if they mustn't impair their capital, is they reveal provisions and losses at the rate that their trading profits allow them and any additional capital they've raised. Now, because we didn't have any new capital raising in the first half of this year, the banks weren't able to provision as much as they had during 2009, and therefore provisions were down. Doesn't mean we're out of the woods. So,
well, exactly. I mean, when we speak about investment strategy, is one of the difficulties right now a lack of transparency, the potential for further write-downs?
Absolutely. I mean, you know, we'll never know that we're done until we're done. That's the great irony of these sort of situations. But history suggests it takes about 5.5 years for banks to work through their bad losses, and that the bad losses are about 10% on their loans. So most of the banks have not achieved anything like that level yet. So it would be only an optimist who would assume that we're done.
So how far along that process are we then?
For the UK banks, if we have an exact replica of a typical sort of crisis, we're possibly halfway through. US banks, maybe more like 2/3, and in Europe, really barely begun.
So still a great deal of uncertainty about further loan losses.
I think there's, well, I would go so far as to say it's not uncertainty. I think we're going to have further loan losses. The uncertainty is about just how long it'll go on. But the fact that provisions are down in a period where we didn't have capital raising doesn't mean that things have necessarily got better. It means the banks have got less capital to absorb those losses. OK,
James, so what do investors do right now?
Well, I think investors have to, you know, look at what the playing field's likely to deal with this coming in the year ahead. And this year we've had improvement in GDP driven mainly by inventory adjustments. In the 12 months ahead, we're going to have GDP mainly driven by an absence of those inventory adjustments, and then the austerity measures kicking in. So what we're seeing at the moment in growth, you look at the States particularly, is not nearly as strong as we would normally see at this stage of the recovery, and that's because the private sector's starved of credit. And with the private sector starved of credit and austerity measures kicking in, it's a fairly safe bet that GDP growth in the next 12 months is going to struggle to beat the GDP growth we saw in the last 12 months.
So should one remain underweight on banks? Do you suggest avoiding banks right now?
Personally, I think that banks have still got a lot of losses still to process, and there is potential dilution coming up if they have to raise new capital to accelerate that process, and I think it's going to be a long time before they're paying handsome dividends again. The market's perception isn't there yet, but yes, I believe we're a long way from getting out of the woods yet.
I suppose some banks are better positioned than others, right? Particularly those with greater exposure to emerging markets?
Well, Standard Chartered obviously has remained pretty much sort of outside of this whole problem. And HSBC has, if you look sort of say at revenue, the peak of the Western credit bubble, revenues, only 61% of revenues came from Europe and the US for HSBC. So if you look at HSBC's loss rates, they are equivalent, in only those areas, they are equivalent to what we've seen historically from a banking crisis. So there's a case to be made that HSBC could be very near the end, and Lloyd's very aggressive loan loss provisioning during last year means that they're further ahead than the pack. So there's definitely winners and losers in the race, as it were.
And interestingly, we've seen a resurgence in retail banking as well.
Yes, well, I mean, you know, if you've really got to sort of fall back on your standard banking. What we saw during the credit bubble was that banks were all competing to grow assets, and by doing that, they pushed down net interest margins. Now they're beginning to realise that a nice, healthy net interest margin is a good, solid, old-fashioned, boring but profitable way to do business.
Presumably, austerity measures in Europe could impact on that.
Well, absolutely. I mean, this is the problem: is that austerity measures are likely to impact on that, and meanwhile, the fee income and the FICC trading profits are also likely to face an environment that's not nearly as good as the last 12 months, which was almost perfect.
James Ferguson, Head of Strategy at Arbuthnot Securities. Good to get your thoughts. Thanks for coming in.
I like your pronunciation.
Thank you.